totally have a hair sticking up right in the middle of my head. I'm gonna have to leave it. You're gonna have to be okay with it, Jenny. It's right there. It's like I'm like a unicorn today.
You had it right there. Put your finger
I know
with the
it's
water.
not laying down.
No, the
So
water, the monster.
anyways, it'll just be fun. That'll be remember that one time you did the Zoom with that one hair sticking straight up for a whole time? Chris Shea will only make fun of me for the rest of my life for that.
Yeah, and I have zero hair, so
I know.
maybe not.
Hey.
I wish I had that
You know.
one hair sticking straight up.
Well, that would be, what is that? The Whoville or Dr. Seuss? Yeah, that's my one hair. So,
Oh, yeah. The Lorax. I don't know.
Lord, yeah, one of those. The Dr. Seuss people. Man, that is gonna annoy me probably more than it's gonna annoy you guys.
You need to pluck it, please?
Pluck it. Allison's gonna pluck it.
Yank it out of there.
I'll rip it out.
See it anymore, yeah.
It's there. I can't
You're too
find
far
it.
back. It's right in the front. It's no farther
No,
forward.
further forward?
Yeah, right by your ring finger.
This is obnoxious. All right, I'm just gonna have to deal with it. All right, well, once I go to share my screen, how's everybody doing? Good? Cool. Anything in particular that anybody wants to know or questions that I can hit for sure today? Jenny, go ahead. You unmuted. You got to have something
Yeah,
to say.
something I saw realtor.com came out with something about why buyers are sluggish in July. I just saw it yesterday. I haven't had a chance to read it. I'm seeing a little weird things going on in the market. So I'm just excited because you're super smart what you're going to talk about, but I just thought we would talk about that.
Well, thanks. I definitely will touch on that. Anything else? All right. Well, all you guys with your cameras off, feel free to jump in. Just because you have your cameras off, you can use the chat. Allison will monitor it for me, and we'll definitely get your questions answered. So I'm going to go ahead and share screen and get rolling here. All right. All right, so hopefully you're looking for the July real estate market update, because that's where you're at. So thank you guys for jumping on. And I'm just going to jump right into it here. I have a decent amount of data, and yet definitely want to open up for questions if you guys have them. So who am I? I think most of you, I recognize most of the names on here, but if you don't know me, I've been an agent since 2004 in Columbus. I do have a team, Marsh Home Group, always looking to add great agents. So if that's something that you're interested in, I'm currently most looking for a kind of management level, leadership level, mentor type agent who's got at least a couple years of experience. So that's my shameless plug. I'm also a real estate investor. I own 15 doors. And then I also am a coach with I Love Coaching Company. So you can feel free to follow me on social media if you're interested in coaching. Also feel free to reach out to me for a free 45-minute deep dive into your business. So definitely that's not what we're here for, but that's a little bit about me. All right, so what are we going to cover today? So we're going to look at inventory and selling trends nationally. So we do promote this to the whole One Team network. And because of that, I like to break things down from both a national perspective, and then at the end, which ends up being probably about a third of it, I spend diving deep into Central Ohio, because that's where I am and that's where I feel like have the most expertise. We're definitely going to discuss interest rates. We do have another big inflation report coming on Wednesday, which is almost every one of these that we do, since we do it right in the middle of the month. So you guys probably tired of hearing about that from me. And yet this month again is going to be a very important one. Hopefully sometime soon in our lives, we can quit caring about the inflation report, just like most of us never did before this year. And maybe you still don't, but it does impact you either way. And then the goal today is just, how to become the local economist of choice. So I'm going to talk to you a little bit about some talking points that you can have if you need a reason to call some of those buyers or sellers that maybe have dropped off the radar, and just present yourself as the local expert. How can you use lending and or the inflation news to do that? Or also, there's also great social media posts that you can create out of it. And then lastly, we'll jump into Central Ohio inventory and selling trends as well. So, all right, so we're going to jump right in. So most of this information, almost all of this numbers national stuff is just our Indeed from realtor.com. So I do have the link on the end. For those of you that are interested in the slides, you can always reach out to me, which I'll have the information at the end, or you can put it in the chat and Allison will send these over to you. But active listing count. So what we're going to see trend wise in the numbers this month is that we're still going to be kind of negative in the grand scheme of things compared to last year, meaning obviously having more active listings isn't necessarily a great thing. However, what you're also going to see is that the trend lines from last year were much steeper than this year, and therefore a lot of this stuff is going to change once we look at the numbers next month for July, if that makes sense. So you can see, like, if we take this line and just continue it out, by the time we get to July, we're going to have fewer active listings nationally than we did last year. Now, that being said, you can see that last year, starting in April through May, June, July, we saw the market just really put the brakes on. And for those of you that were in it last year, we definitely started to feel that. The reason why it didn't feel as crazy as maybe it was is simply just because we were still closing deals that had 75 showings and 35 offers. And yet, if you were active in the market with a buyer last year in the spring, there was definitely a time where 2 weeks ago, there would have been 60 showings, and then all of a sudden there were like 20 showings. And so we saw that, and most of that was driven by interest rates. All right, so we see kind of the same thing. Pending listings get a little bit messy here. But what we can see is that our pending, it's this pink line here that almost disappears. And again, this is nationally, but we're kind of right in line pending wise with pre-pandemic levels. So if we kind of look at the color-coded numbers up here, we can see that this line was 2022, this line was 2021, and then this line was 2020. Now, 2020 was a weird year because of the pandemic. We saw kind of a late spring market, and then things really never trailed off as we moved on. But if we look at 2022, I still think that we're going to end the year in a better place than last year. This might be one exception because of the lack of new listings, which we'll get to in a second. Newly listed homes. So this one is the big driver, in my opinion. As you guys all know, we would be in a really, really different market if we had 26% more new listings. Meaning the market would feel much more like a buyer's market, I think, if we had more new listings, or what would be considered average. If you look at it, even last year, which is this yellow line, we were below the average. So if we come up here, these lines, the blue, orange, red, those are all from 2017 to 2019, which most people would agree was a pretty balanced market. I mean, here in Central Ohio, we definitely were leaning towards seller, but definitely pre-pandemic, ironically enough, there was a slowdown kind of in 2019. And so we had a pretty balanced market. You could find a house for a buyer. I think it wasn't until the summer of 2019 that I saw my first appraisal gap ever put in a contract. Like, so those years were definitely more of normal. So when you look at the fact that we're like 30% below that in terms of new listings added to the market. That's significant because of and the reason that's significant is because right now we've kind of been treading water with our inventory, and you'll see that I think on the next slide. But the reality is, if you had 26% more sellers out there, you would not be selling all of those houses. But because we have 26% fewer sellers than normal, we're still selling houses faster than average. And the only years that have been better over the last 6 years were 2021 and 2022. Okay. And so if this trend line continues, which we expect it to continue, I would expect sometime in that October to November timeframe at the latest, that will be better in terms of days on market as well than last year. Median list price. Now, for some reason, Realtor.com does not publish a graph for the median sales price. I don't understand why. They reference it in their write-up with these graphs, but they never post it. So we're talking about list price. Sales price follows similar trends, but ultimately we did go to a number lower in terms of list price than year over year. However, I anticipate that we'll continue on more of an even trend, or maybe a slower decline than what we saw last year. You can see one thing I wanted to point out about this, and Jenny, this kind of goes to your question, which we'll dig into more when we get into Central Ohio, because I have the sold graph. But you can see, if you look down the line here, even going back to 2017, typically May or June actually are typically the peaks in terms of pricing for every year. Now, part of that is because we see the most expensive houses typically list in that spring, summer timeframe. And so when we're looking at median or average prices, sometimes it's just the fact that the more expensive houses may not list during the winter months. But also some of it is that demand drops off in the fall. And when you have fewer buyers, you're going to have less multiple offers. You're going to see less over list. Or in a normal market, you're going to just see bigger price reductions given by the most desperate sellers. So that's definitely one of the reasons why we see that. The other reason why historically in my career, I started my career a lot on the buyer's side of the business because I was on teams. Once I started on the listing, I remember the listing where I just wasn't worried about it. And I was like, well, let's not list it on July 4th. Let's list it the week after. And literally it was like the floor had fallen out of the market. And so then I started researching it, and buyer demand definitely falls off beginning basically the last weekend of June, but absolutely whatever weekend was around the 4th of July drops off. And the biggest reason is because a buyer can't go into contract and close before school starts by the time you get after the 4th of July. So if you're a buyer and you have kids in school and you haven't found a house yet, your main push and motivation in June was probably to get into contract so you could be moved in before school starts. Well, now that arbitrary deadline is gone. So does it really matter if I go into contract 2 weeks from now? And frankly, do I really want to go into contract and be trying to move during the first week of school for my kids? No, probably not. So buyer demand doesn't disappear, but everyone goes on vacation in July. And if you don't believe me, just look at your Facebook and Instagram. So, and that was happening last month too. I think one weekend I was negotiating like 3 contracts, and between the agents and the clients and myself, that more than 50% of the people involved were all on vacation, which always makes it fun. But yeah, so that's the biggest reason why that happens. And as you see, you'll see everything kind of have a downward trend from here. Price reductions. definitely are a trend, but it's a normal trend. If we see, like last year, we saw this massive increase in price reductions from April until June, and that definitely was an indication that things were changing in the market. If we look at previous years, we're definitely on a more average trend line for previous years in terms of price reductions. And frankly, last year, the level that we were at in terms of price reductions was abnormally low, and really, except for in 2021, was really an anomaly. All right, regional comparisons. I always find this stuff super interesting because, again, and we've talked about a lot of this stuff already, but we see that nationally now, even in the West, which these numbers had been negative for a while, everything is trending back up again. Now, that's really good for real estate, but it's really not good, because if you've been coming to these talks over the past several months, one of the biggest portions of the inflation measurement by the Fed, which is what they've been really hanging on in terms of whether or not they're going to raise interest rates, has been real estate. It makes up about 40% of the inflation number. And when real estate was negative year over year, it was kind of like we were talking about how that was going to help keep the inflation numbers down, which was then going to result in the Fed either stopping interest rate hikes or maybe even lowering rates. And now, though, now that we're in the middle of the year, when we thought everything was going to be really negative, now things are actually positive, and in some cases double-digit positive. And so, unfortunately, as we get to in a few minutes, you know, the interest rate conversation is going to be continue to be one that we're going to have. And frankly, I mean, I was on here predicting, as were many experts, that we would be on the downward side of all this by now. But the economy overall has just been a lot more resilient than most people expected it to be. I think this is always a cool number. And if you're looking to talk someone into buying real estate instead of sitting on the sidelines waiting for the crash that doesn't seem to be coming, ask them this: 2017 to 2019 compared to June of 2023, prices are up between 32 and 40%. Are you willing to miss out on that appreciation? The reality is, which we'll get into in a minute as well, is that if everything else is going up, meaning inflation is going up, what are the chances that real estate is the only thing that's going to go down in value? Probably not very high. We see, again, days on market up slightly year over year, but still compared to historical averages, very good. The number of properties that have a price reduction, still very good compared to historical averages. All right, I drew a bunch of stuff. I kind of got carried away, to be honest, with my pen earlier. But ultimately, at the end of the day, what we see is that when interest rates tend to trend upward, they do it pretty quickly. And when that happens, we see a pretty immediate slowdown in the market. Okay. And so we have these time periods. And for those of you that have been consistently busy over the last year, if you really think back to the periods of time when you were busy and slow, they probably correspond pretty closely to this graph. Meaning last fall, things like the floor literally fell out from underneath of us. Like I had a listing first weekend, got 2 offers. One was way above list price. Buyers got cold feet 1 weekend at the inspection, fell out of contract. We sat on the market for 30 days. And that was all within a period of basically a week and a half. And that was right here kind of at the end of September, right when things had really started to trend upward. And we basically had to wait until things started either normalizing here or going back down, and then we got an offer. You remember over the holidays, it was busier than anybody expected. And then things started ticking up again. And then now we've been in this like weird period where it's just kind of sitting at 7%, but it's definitely impacting things. I mean, I don't know about you guys, but I mean, I probably have 10 to 15 past clients that would be a buy and a sell, who once they went and talked to their mortgage person and realized what their new payment was going to be, they're like, never mind. I'm good. My house is fine. The longer rates stay here, the harder it's going to be for people to make that move that is more of a convenience move than it is a necessity. So you're going to see people that are relocating. You're going to see people that are getting divorces. You know, I call it the 4 Ds: diapers, death, divorce, and disease. Those are the things that you don't have any control over for the most part. And you're just, and maybe the 4 Ds and an R, relocation, right? Like those are the reasons why people are moving now. Most people aren't running to the bank to pay an extra $1,500 a month for their mortgage than they were just a year and a half ago. But what I am seeing, and you all might be, and I'd be curious if you're not, definitely speak up. What I am seeing though is some of those buyers that may have decided a year ago not to do anything are still kind of hanging around. And I think they're becoming more and more comfortable with 7%. And it'll be interesting to see, now that we've been there for a period of time, whenever the decline does come, if we go back to 6%, is everybody going to rush out and think it's the greatest thing that ever happened to the real estate market, that we're back down to 6% rates? And that's something that I think there is a number, and I've got that in one of my following slides. So this just highlights the mortgage payment change. Obviously, most people have given up the idea of receiving this ever again. But to put it into perspective, a lot of our clients that already own properties live in this. And remember, their prices, their mortgages are also 40% lower, right? We saw that 40% appreciation. And so when you think about the fact that the prices have to come up by 40% in order to just buy the same house that they bought 5 years ago, and their rate is going to be this much, is going to cause their payment to be this much higher, it's a pretty significant bump, plus property taxes, obviously. All right. So ultimately, the next couple slides are those talking point slides that we've talked about before. I know I spit a lot of information at you guys, and so I threw this in here a couple months back as just like, if you can take a couple points away from these slides, what could you talk to your clients about? So the first one is inflation. Ultimately, if you know nothing else about why interest rates are going up, you can tell your clients it's definitely due to inflation. Inflation is the reason why the Fed keeps hiking the short-term rates. And then that's the same thing that puts pressure on the long-term rates. And to dive as shallow as I can without going down a rabbit hole, the reason that is because no one is, if you're someone or a company or a business that has $1 million and you want to park it somewhere to earn safe interest on it, no one is going to lend it out on a 30-year term for a rate that's lower than what they could get if they rented it out, if they lent it out on a rate that was 1 or 2 years or 3 years long. So what has to happen is when those short-term rates are giving a bigger return, like maybe I can get 4.5% if I lend this money out for 1 year, like on a CD, for example, I'm not going to lend it out for 30 years at the same rate. I'm going to want more in order to compensate for the fact that I'm not going to be able to touch that money for 30 years, potentially. And so that's why the short-term rate, even though the Fed funds rate isn't actually the same as mortgage rates, but that's why mortgage rates tend to go up, even though they're not technically directly tied to those short-term rates. So Wednesday, we're going to receive the June numbers for the CPI, which stands for Consumer Price Index. And basically, the Federal Reserve just has a formula where they take the prices of everything that's sold in the United States in the month of June and compare it to everything that's sold in the United States in the month of June in 2022 and say, how much higher are the prices this year compared to last year? But then they're also going to look at, which I have down here, they're definitely looking for a lower year-over-year number, which has been true for most of this year. But now they've started to get obsessed over, did we drop from last month to this month? Or how much higher are we from last month to this month? So they want to see the rate of increase month over month going down. So if from April to May, prices went up by 4.4%, then they want to see prices go up from May to June by 4.2% to see that the things that they're doing are causing prices to slow down, to grow slower. And so the longer that continues to not happen or not happen as quickly as they want it to, the more likely they are to continue raising rates, which they keep telling us they're done. And then they keep saying, no, we were just kidding. We're not done. So right now, the money, there's like a Vegas for Fed funds rate. And the money is on 2 more rate hikes between now and the end of the year, which is going to put short-term rates up near 5%, which is the highest that they've been in a very long time. On top of understanding Fed funds rate and how it compares to mortgages, I think the other things that you guys can do to add value to your clients is understanding different mortgage products. I think the higher rates are, the more you need to understand how points, buy downs, and adjustable rate mortgages can improve somebody's payment, sometimes significantly. I would also be looking at new construction. The builders understand that rates are one of the biggest reasons why buyers aren't moving. And so they're subsidizing their properties by offering much lower rates, some of them in the low 5s. And so if your client can buy a new build, that may be a payment that feels good to them, but not necessarily an existing. And obviously you have no competition. There's all kinds of reasons. But if you don't understand how to explain that payment and what happens, they may never even be willing to go meet with a builder to find out the details. So make sure that you're understanding that. The lenders would love to take you out to lunch or dinner, or coffee or beers or whatever right now. So take advantage of that. Take 2 or 3 lenders out, or have them take you out and explain to you. Ask them what things how have they helped. Think of the hardest situation you've had over the last 3 months. How have you helped a buyer still get into the home that they wanted? And have them tell you the story. Now that story becomes your story, right? So now you get to tell your clients, hey, I was talking to my lender the other day and this scenario happened and this is how they handled it. I think that's something that might work for you. I always say that's one of the biggest benefits of being on a team, is that you get to live vicariously through the stories of all the team members. You get to learn when a team member makes a big mistake. You get to make that mistake with them, except it's not you that made it. So learn from others' mistakes and leverage your lender to have those experiences to help your clients. The other thing that I think that you can do is show your clients how to leverage the equity in their home. Home equity is at the highest levels that we've ever been in history. And so, especially because prices went up so quickly. And so make sure they understand how to put a home equity line of credit on their house so that they have access to that. Now, encourage them, don't go out and buy a car with it, or don't go out and buy a boat with it. but there are ways that you can leverage the equity that you have. And still, for some people, even though rates are high, if somebody has a ton of additional debt, let's say credit card debt, did you know if you're someone who's very responsible, maybe you don't have credit card debt, so you don't know this, but every time the Fed raises rates, your credit card interest rate goes up immediately the following month. And so there could be somebody that a year and a half ago thought it was fine to pay 10 or 12% interest on their credit card. And now that same balance that they had, their interest rate is 20 or maybe even more than that percent. And you think that they care about refinancing their mortgage from 3.5 to 7. Their credit card payment just went up double. And so in some cases, it could still make sense for somebody to refinance. And so again, if you're looking for ways to add value to your database, let's say you're a newer agent, and I mean, all of us have the opportunity to do this, but look, it doesn't always have to be about selling a house, but learn this stuff and learn how to have these conversations and help them so that the law of reciprocity kicks in. Maybe they'll send you a referral even if they're not ready to buy. So make sure you understand all of that. All right. In a quick page, here's my opinion on the market. So if you're in a growing city and have low inventory, you'll likely to continue to see lower than normal days on market for all the reasons that we talked about. Buyer activity is down, but the new inventory and lack of new listings is simply down more. And that's the only thing that's keeping most markets in equilibrium. Meaning that's the only reason why we have low days on market and we're still seeing multiple offers, is because there are fewer new listings than there are fewer new buyers. But if we saw new listings tick up even 10%, so we were only 15% lower than normal, my opinion is that's probably right around in Central Ohio where our equilibrium number is. If we saw it continue to inch closer and closer to normal in terms of inventory levels, which there's a number of reasons that could happen, but we haven't seen any sign of that, but there are things that could cause that to happen. Most notably would be job losses. We could see the market turn downward quickly if something like that were to happen. But I did touch on this earlier. The target for interest rates to really begin to reinvigorate buyer demand in the market seems to be around 5.5%. We saw that briefly earlier this year, like at the end of last year, beginning of this year, and we really saw the number of buyers pouring into the market increase. We haven't really seen those numbers since then. And so I do think that if we go back to that number, we're going to see buyer demand really increase. We were all hoping and thinking that that might be happening around this time, but again, largely due to stubbornness in pricing and housing, we just haven't seen inflation drop as much as the Fed wanted to, and therefore we've seen rates stay high. Here's the question that I think you should ask buyers who are on the fence. What's the likelihood that over the next 3 to 7 years, especially 5 to 7 years, you ask them how long they want to stay in their house? What's the likelihood that prices will go down in your area? With Intel and all the other things happening in Columbus and 5 of the 5 most largest investments that have ever happened in the state of Ohio happening all at one time in one area, the chances of that being true are almost zero. And frankly, it didn't even happen in 2008. And so this idea that because prices go down for a year or two, that all of a sudden it doesn't make sense to buy now is crazy. The only time that the value of your house matters is the day that you buy it and the day that you sell it. Everything in between is just an emotional roller coaster that you don't need to pay attention to. So somebody needs to be betting on the long-term viability. Now, if you're having a conversation with a house flipper then that's a completely different conversation, right? Because they're looking at the market in the next 6 to 9 months, and that has a lot more potential for volatility and carries a lot more risk. But the average buyer, if all they're worried about is trying to time the market, ask them how much money they've lost over the last 6 months trying to time the market because of appreciation. It's a lot. So yeah, the last paragraph is basically the same. So the shorter the time horizon, the more risk that's available. But I mentioned this earlier, is it really likely that inflation is going to increase and be the cause of the economic slowdown, except for real estate? And my opinion is no. So especially since much of the rise in real estate has been due to constricted supply, which with higher rates, I think will continue, because I think buyers that can stay in their home will stay in their home until rates level off kind of in that historical norm, which is closer to that 5.5% to 6% range. All right, so that was the end of my national portion. Anybody have questions before we jump into Central Ohio? No? All right, well, we'll jump right in then. For those of you that aren't in Central Ohio, obviously you're more than welcome to stick around, but if not, thanks for coming. All right, so this is all of Central Ohio here. So a couple things that this is coming from Trend Graphics, by the way, but a couple things to note. So you can see, again, the dark green lines are the number of sold in a given month. Last year in springtime, we were massively, we were selling much faster than 1 month. Then in July, the close came close, same in August, and then September, the closed were less than the active. And then that number that gap continued to widen as interest rates got higher and higher. Then that gap came back together early in the year when interest rates dropped. And then in March, solds overtook the actives again, and we've kind of been back in that place. The biggest issue though, look at the new listings. I mean, and I know we see them in those other graphs, but like if we go across the page, we're like right here last year, and look where we are this year. We just have so many fewer new listings, and that's just the problem. The closer the in contracts, which there are the red line, are to the blue line, the more we're just going to stay in that environment, right? Because that basically means that every new listing that comes on the market, we're putting into contract essentially right away. So when that gap increased, you can see last spring, then following that 2 months later, we saw the numbers switch, right? And then they came back together, even went negative, and then they switched back 2 to 3 months later. So you're going to continue to see that trend happen until we see more inventory in the market, in my opinion, especially because we have so much relocation. I don't know about you guys, but we're definitely seeing more and more buyers, especially the ones that are ready to make a decision, are people that are relocating. Same thing, frankly, with sellers. Obviously, some people are moving out as well. So new listings in June of this year versus June of last year, down 23%. Pendings were down 17%. That's just a function of fewer new listings. And then June's been the first month this year that the actual active number of properties is lower than the same month last year. So actually, I'm sorry, the 16.9 are the solds that are down. The pendings are actually up a little bit. Part of that is due to new construction. So new construction, we're seeing the pendings up 3.2%. So that's making, and then resale are only up 1.2%. But if we look at resale new listings, actually the number of new listings is down by 25%. So just ultimately at the end of the day, the two biggest stories are interest rates and new listings. So this is looking at the first 9 days of the month. I like to do this just to say, like, obviously the June over June is looking backwards. This is looking at the first 9 days. Are we in any better position in the first 9 days of July? Unfortunately, the answer is no, we're in a worse position. 33% fewer new listings. The number of active properties is down. The active properties go by the date. So it was on July 9th last year. We had 2,764 active listings. This year we have 2,067. So down by 25%. And that's going to continue. That gap is going to continue to widen, I think, pretty quickly here over the next couple months due to the number of listings that were coming on the market but not selling last year during the late spring and early summer. So I would anticipate that our solds, that seems like a drastic number. I don't think that'll continue for the whole month by any means, but we'll definitely continue to see our solds be in that like minus, 16 to minus 30 range, unless we see more listings. Days on market, we actually bumped up a little bit in June, which is somewhat surprising. But what we also bumped up on is the average sales price to original list price. So this is also taken into account properties that did price reductions. It's not actually factoring in that lower price. It's what they originally listed for. So you can see ever since July of last year, we've actually been below 100. And then in April, we got back to 100. And now the last couple of months, we've been over 100. Not necessarily a stat I would go screaming to your clients, especially right now, as Jenny mentioned at the beginning. I think we're seeing definitely some softening in the market, definitely some weirdness going on, especially in certain sub-markets. So remember, this is the total market, but definitely an interesting number to say the least. This is supply of resale inventory. You can see that we got up to 1.2 months of inventory, and then we've kind of bounced back in between that 0.7 and 0.8 months. At the end of the day, we're well below what we consider a balanced market, which is 4 to 6 months. So we're still in a strong seller's market. And then new build inventory is still up above 2%. Again, this is all based off MLS stats, which is, or I'm not, sorry, not 2%, 2 months. This is all based on MLS stats, which obviously builders don't put every new listing in the MLS. So it's really just more of a snapshot of how things compared to a few months ago. But you can see, again, the builders got really desperate when things slowed down here at the end of the year. And so they started putting everything on the MLS, if you guys remember that. And so now I just ran across a couple things last week that were going to be done in the next couple months, but weren't on the MLS for some reason, which didn't make a lot of sense to me since they had a bunch of other stuff on the MLS. But hey, it's not my show. So all right, average sales price to average list price. Again, like I talked about before, they tend to trend in the same direction, but obviously the averages are different. So you can see that's all continuing to go up pretty healthily. I don't think that's a word. Pretty healthy. It's pretty healthy. It's going up. I don't know. Anyways, it's going up. And so we're seeing it go up month over month and then also year over year. So the average sold price was up 4% compared to last year. But again, I think we'll start to see that gap widen quite a bit when we start going further into the year, because as you can see, starting in June of last year, that was our peak. We saw prices kind of trend down quite a bit until they hit the bottom. They were actually about, 62,000 below their peak in January. And now we're back up to year over year appreciation. So we've moved quite a bit higher than what most people thought we were going to. So I think we'll continue to see that number increase between now and the end of the year. And actually, this slide is not really relevant, didn't get updated. So here are my sources. So I use Mortgage News Daily for the interest rates, realtor.com. We talked about Trend Graphics. We talked about if you're at consultants, we have access to that if you go to kwcresources.com. Zumper I use for the rental information, and then I actually didn't have anything from apartment list today. So what do you guys have in terms of questions? Anything that you saw that you didn't understand or that you wanted to go deeper on? Somebody has to say something. What are you guys seeing? There's some big hitters on here in terms of agents. What are you guys seeing in terms of activity on your listings? If you want to put it in the chat. And what are you telling your clients in terms of expectations for showings and offers? Presentation 101 says I'm not supposed to pick on you guys and call you out, but I'm about 3 seconds away from it if somebody doesn't. All right, so we have one here. Not Diane said, great, not as many showings, but offers within 2 days. Somebody sent for sellers, it's still a good time to list because we're lacking inventory. Susan asked, is anyone seeing a slowdown for listing 600? Susan, did you mean a slowdown in listings or a slowdown in like houses are sitting on the market? Offers for those listings. Diane, are you seeing any kind of offer, any kind of slowdown in terms of overall activity or demand for high dollar listings? Since I know you tend to specialize in that market. Less demand. Cool. Chris, did you mean to say anything other than W?
Yes. So I hit my fat finger hit it. So I guess one of the things Chloe and I are seeing, she's been putting some in the contract in that lower price market, like a lot more coming up in that sub 200K,
Yeah,
200K and lower.
200 and below, I feel like I've been able to negotiate a lot for our plan.
Getting a lot of like even buyer concessions and seller
Yeah.
paying for buyer concessions. And that goes with like kind of what you're talking about. I think with the inflation staying high, that's tends to seem like the market that'll get hit the hardest is people that are paycheck to paycheck, maybe have to sell a house or tap into some of that equity. That's what I'm hearing from lenders too, is that they're not going to have a slew of foreclosures, but they are having some of that start to come to fruition because they don't credit card debts at a high, they don't have any cash reserves. So anyway, it just seems like there's going to definitely be some activity at the lower end.
Yeah, it's ironic. I think there's some price compression to Susan's question and then Diane's answer. I think there's some price compression, especially in the sub-million market, meaning some of those people that like to live a high dollar lifestyle, but are somewhat paycheck to paycheck, but just buying an $800,000 house because they make enough to do that. But their payments that they're seeing are a lot higher. And so it's forcing them into a lower price range. And so there's a lot of competition in that 400 to 600, 400 to 700 that maybe used to be spread out more to that 7 to 9. But that's an interesting, it's an interesting comment about the lower price range. And I definitely agree with that too. And I'm hearing the same thing from lenders. And I think realistically, it's an unfortunate reality is that usually when we do go into a recession and job losses happen, it tends to hit the lower rungs a little bit harder because they are paycheck to paycheck. One thing that I didn't put in the slides, but I was just listening to a podcast over the weekend is, and I'm not trying to start a political conversation, so I'm going to speak only facts, but the Supreme Court said that the administration was not allowed to give student loan forgiveness. And so because of that, everybody, and they also agreed as part of the debt limit raising that they were going to stop the student loan deferment that had been there since COVID. And they said that the average student loan payment is $350 a month. So if you have buyers that have been living or owners that have been living a lifestyle based on $350 a month extra in their lifestyle for the last 3 years, COVID, was over 3 years ago. There's people that haven't paid a student loan payment in 3 years, and now all of a sudden they have an extra $350 a month payment. Oh, and by the way, they just got laid off, right? Because that's what the Federal Reserve says that they need to see happen before they stop raising rates. You have to imagine that their only opportunity could be to Chris's point, is to sell the house, because if they don't have a job, they can't refinance. So that's interesting. Anybody else?
Hey Troy, it's Chloe. Chris and I are in the same room, so if we both have our microphones on, there's feedback. But okay, so with the national data, you said that we were down year over year on median list price, but then I think when we looked at some of the regional segments, that didn't seem to be the case anywhere. But I guess that was just for the top 50 cities. So is some of that data kind of saying okay, well, like you said, in the more booming city areas versus more rural areas, we're seeing much different things go on? Is that how you interpret that?
Yeah, that it is. And it wasn't by much either. And so, yeah, I definitely think that you're just there. It's comparing two different segments. They're two different data sets. And so you definitely sometimes see a little bit of variation.
Okay.
But I would say in Central Ohio, though, obviously, we're seeing year over year increases pretty consistently.
Cool, thanks.
Are you seeing, Chloe, with investors,
Yeah.
or is it more like owner occupants that are kind of buying at retail prices that you're seeing that softness?
It's been more first-time buyers. I've had 2 recently where I got almost 6%. Because with the FHA loan, you can get up to 6% towards your closing costs. So, and in both scenarios, it was okay, well, we need to check the seller's bottom line to make sure they're going to break even after the sale. So,
Nice.
Kind of just like what Chris was saying, that pressure that lower end of the market is feeling, it might already be starting to happen.
So are those sellers, had they bought recently, or were they just had refinanced, or why were they so close on what they owed?
Both of them had bought in the last, I think since 2019 or 2020.
That's interesting.
Mm-hmm.
Interesting stuff. Yeah, cool. Anybody else? Good questions today.
We could talk about investment stuff separate too, if you want, because I've got some stuff on that.
Yeah, go ahead. Share.
Oh, I was just gonna say, in speaking to some lenders that we deal with for investment, they're saying they're starting to see a pile up of defaults on loans, and nothing like 07, 08, but when asked why, they said, well, a lot of them are multi-unit owners that aren't getting rent paid for the same reasons we're speaking of. People get laid off, paycheck to paycheck, can't pay their rent. Well, if you've been over levered on multiple multi-units and now you can't pay your mortgages, that's what they're starting to see some defaults in. So it'd be interesting to track those trends to see if that, but I think we're going to be in the same boat there. We got enough investors sitting on the sidelines with cash, they'll be ready to buy those up. I just think, we're starting to see just the cracks happening where there'll probably be more opportunities for that. I mean, look on the MLS and look at how many half flipped houses you see for sale or partially started, and now they're unloading them. So I think that, you know, again, it's not gonna be a huge chunk of foreclosures like 07, 08, but I think there'll definitely be opportunity there.
Yeah, I think especially in that, like in the commercial market, you know, you have that whole conversation as well in terms of, you know, what's going to happen to anybody that has an adjustable rate mortgage. The other thing I saw last week, which I actually should have included in here, but Airbnb published like some data, and essentially there were several markets, including many very large markets, that saw up to 50% declines in revenue per month compared to just last year over the first 6 months of this year. And if you're an investor and you've been Airbnb-ing your property, or like, let's say you bought one in Gatlinburg based on, you know, the COVID rates in terms of income and revenues, and then now all of a sudden those are cut in half. I mean, you don't have the equity, right?
Yeah, yeah, because those houses were valued based on their income potential, not like the
Exactly.
appraisal that would be, you know, what a normal residential buyer would pay for it.
Yeah, so even though they don't technically have commercial loans, because most of them are on 30-year fix, so they don't have that adjustable rate, but their income just dropped by 50%, like they need to sell. And so I think in some of those sub-markets in particular, and then obviously I don't think there's many, if any, commercial agents, but the office space environment, nationally at least, is in brutal shape. So, but everything is local, you know, too. I mean, like in Columbus, Ohio, we don't really have nearly the same issue with office as we do in other parts of the country, but there are definitely some places that are hurting hard. And I think the multifamily space is definitely pretty exposed when it comes to some of the loans that are out there. And we'll see some defaults and stuff in those arenas for sure. But cool. Well, tons of interaction today. I love it. Does anybody have anything else for the last minute? No? All right. Well, thank you guys all for jumping on. It was awesome. Even in July, the fact that all you guys jumped on instead of going on vacation. So I appreciate you always. And feel free to reach out to me, Troy@marshhomegroup.com, if you want a copy of the slides, and I'll have Allison send those over right away. Thanks, guys.
Thanks, Troy.
My hair is still standing up. I'll cut it out for you and bring it down with glue. Okay.
Perfect.
I'll see you, man.
Right.